Welcome back to Renewable Rides. Today's highlight episode comes from our conversation with Mark Ellis. Mark is an independent consultant and expert witness in utility regulatory proceedings, with a background that spans engineering, strategy, and economics. Mark previously served as the Chief of Corporate Strategy and Chief Economist at Sempra, the parent company of San Diego Gas and Electric, SoCal Gas Company, and Encore Electric Delivery in Texas. In this clip, Mark breaks down the utility business model in plain terms, from cost of service regulation to how utilities actually make money. He walks through the three core components: operating costs, return of capital, and most importantly, return on capital, where all the profit lives. But the real insight comes when he explains the incentives. Utilities grow profits by increasing how much they invest and the return they're allowed to earn on that investment. And according to Mark, that dynamic is driving tens of billions of dollars in excess costs for customers every year. We also get into what it means right now, as demand for electricity surges for the first time in decades and the grid requires massive new investment. If you want to understand the mechanics behind rising rates and the structural forces changing the grid, this is the conversation you don't want to miss. Let's dive into the conversation with Mark. How do they make money? How do they think about, 1, 5, 10-year plans and growth?
Right. Yeah. So utilities are the basic model for utilities. I'll describe first sort of the normative, how it should be, and then I will get into the descriptive, how it is. So I'm going to describe normative. So the normative standard for utilities is called cost of service regulation. As the name implies, cost of service, basically utilities are supposed to recover in rates their cost of service. And cost of service is defined as things, costs that are actual costs, like you can't make up numbers or say, oh, there's a shadow cost, right? It has to be a real cost and it has to be prudently incurred. So if they're, buying expensive golf memberships for every employee, that's not a prudent cost and you can't recover. That's not controversial, right? That's, prudently incurred costs you're allowed to recover. So what are their costs? So you can generally bucket their costs into two categories. So the first one is operating costs. And these are things like they just incur them on a daily basis or annual basis, and you kind of recover them as they're incurred. So that would include things like salary. If they have a power plant and they're procuring fuel, like the gas, right, would be the gas for the power plants, it'd be rent, would be their taxes, property taxes and income taxes, just everything that, sort of they're incurring on a daily basis. And basically the idea is whatever they pay, they roll it up and they pass it through into rates, and there's no markup. Like it's cost of service, not cost plus rate. It's cost of service regulation, not cost plus regulation. So they just roll that up and pass it through. But not all their costs. So not all their costs are sort of incurred and consumed at the same time. So they make capital investments, and for capital investments, they don't. They pay for them today, but they don't recover all the costs today, and they do that for two reasons. The first is that if they built a transmission line and cost $2 billion and they put $2 billion in their revenue requirement, then the rates would spike, and you can't do that to customers. So they spread it out over time. And the second reason why they spread out the recovery over time is if they made an investment and they recovered all of it today, then what's the incentive to maintain that investment over time, right? They'll just let it go to pot, right? And they won't maintain it. So you say, hey, as long as you can recover it for as long as it's expected to. You can recover the cost for as long as you expect it to be in service. So transmission line might be 30 or 40 years. And so this is not unique to utilities. All businesses have this, where they make an investment and they recover it over time. And it's called depreciation and amortization. So, and you can think of that as it's also a cost. It's and so the depreciation and amortization are the return of their capital, right? So they recover their cost over time. And so that's a chunk of that's a third chunk. You have the ongoing cost, you have the return of capital. There's a third cost, and we're all familiar with this because most of us have some kind of loan, and it's like a cost of money, right? Or the time value of money. Because you say, well, I'm only recovering it over time, but time has value, right? So if I'm recovering it over time, I get some kind of return on my investment.
Yeah.
And so that's the return on capital, right? That they're allowed to recover in rates. So you have operating costs, you have the return of capital, and you have return on capital. So it turns out that the return on capital is where all their profit is, right? So because it's that time value of money that is not, it's not necessarily observable in the way that the other costs are, that the regulator has to approve these. So I'm going to unpack just that return on capital component for a moment. So when utilities make an investment, they finance it with two sources of capital. And again, this is not unique to utilities. Virtually all businesses finance their investments with two basic sources of capital. They have debt, they take out a loan, and then they have equity. And we do this ourselves. Like when we buy a house, right? We get a loan, but you also have to have a down payment. That's the equivalent of your equity, right? So they finance it with debt and equity. And generally it's, give or take, but most utilities, it's around 50% debt, 50% equity.
Okay.
Right. And so then they're allowed to recover, again, the depreciation and amortization. And then, well, what's the cost of the debt? The return on capital for the debt is just whatever the bank or the bond market is charging them. So if they issue a bond and the market says that bond, $1 billion bond, 5%, well, that's what they get their recovering rates. Pretty straightforward. So the wrinkle, though, is what's the return on their equity? That's not something you can go look up. It's not in a contract, and you can't look it up necessarily on a Bloomberg screen or Yahoo Finance. That is something that has to be set by the regulator. Currently, that it's set by the regulator. And that's where all the rub is, because that return on equity is actually also their profit. In other words, you take the amount of equity and you multiply it by, they call it the return on equity, ROE. Return on equity times ROE is equal to their profit.
Yep.
And profit can go by several names. It could be net income, profit, earnings, has a variety of names, but basically the equity, the amount of equity times the ROE is equal to their profit. An IOU, an investor-owned utility, is a for-profit company. And like every for-profit company, they want to maximize their profits. Right? So they have two levers to do that, right? They can increase the amount of capital they invest, right? That drives up the amount of equity. So, right, the profit equals equity times the return on equity. Yep. So they can increase the amount of equity and they can increase the ROE. So they spend a lot of time focused on dialing those two knobs and turning them up as much as, to 11, right? In each case. So that's basically the utility business model. So I'm going to step back now and go back to, remember I said that the utility regulatory model is called cost of service regulation. So that applies, and I described like, okay, you're recovering their actual costs. The depreciation is based on your actual cost. Like it cost $1 billion and then they divide it over 40 years. The interest is based on the actual cost. The return on equity also should be based on the actual cost.
Yes.
So what's the actual cost? It actually took a couple of decades for like the legal system to kind of articulate what they mean by the cost of equity, like the return on equity should be equal to the cost of equity. But in the 40s, they basically said, oh, it's the market-based. In other words, it's what an investor would require, the return an investor would require on an investment of comparable risk in the market. And that's it. And the important thing is in the market. In other words, it's based on what they can get in the stock market, not what other utilities are necessarily earning or what Apple is earning or in terms of their return on their investment. It's what an investor like you and me in the stock market would be able to get if we invested in a utility stock. What's happening and what's been happening for decades is that even though that ROE should be equal to the market-based cost of equity, COE, regulators have been awarding ROEs well above the COE. And what that means, if the ROE is equal to the COE, then the stock market value of their equity, right, that shows up in their stock price, would be exactly equal to their investment. So if they invested $1 billion of equity, then their stock market value would reflect $1 billion in the stock market. That is the bedrock principle of finance. It's called present value, right? That's sort of like finance principle number one, even before risk versus return, right? Present value is the bedrock principle of finance. Nobody disputes that if the rate of return were equal to the cost of equity, then the stock price should be equal to the amount of equity they have. So we know that utilities trade at like I think I just looked 2.2 times the amount of equity they have invested. And the only way that can be true is if the authorized rate of return, authorized ROE, is greater than the market-based cost of equity. So every day you're stared in the face, like you can go on Yahoo Finance and look up the price to book value of Duke or Sempra or any of these utilities, PG&E, and they're all well above 1.5 to 2.5. Some are in the threes. So you're stared in the face every single day in real time, like, hey, the regulators are authorizing these ROEs much higher than they should, than the law tells them they should. And everybody just shrugs their shoulders and says, yeah, that's how we've always done it. Mm. And I just think, well, how much is this costing customers? It's like real money. And I worked it out. It's about $50 billion a year nationwide. I just filed testimony. So California is doing their cost of capital proceeding right now. I just filed testimony last week, and so the utilities all asked for 11 to 11.75%, like outrageous, really high. And I calculated if it was the market-based cost of equity, it would save customers over $6 billion a year.
Wow.
That's a lot of money, right?
Yeah.
Just in California, it's $50 billion nationwide, $6 billion in California alone. So we're talking real money. It's about $300 per household on average across the country. That's just, in residential. Businesses are also paying for this. Big tech is paying for this. Everybody's paying for this. If it's an investor-owned utility. And it just seems like, hey, there's a lot of money here. And it's just even in the regulatory literature, they refer to wealth transfers. It's an unearned wealth transfer from consumers to utility shareholders.
So as a business leader, and I see my rates going up, and I think a lot of people don't realize that's like a compounding escalation effect as well, because it's 5% on the previous year being even higher than it was before. How is this justifiable, and where does it stop? Because we're in a position now where the grid is obviously needing a lot of investment, and it seems to have been underserved. How has the system been allowed to operate the way it has without also delivering the level of service that we expect and need and want to meet our ever-changing demands?
Yeah, so this is a really complicated question, right? So, because there's multiple parts to it. Like, how did they get away with this for so long? And then how are we going to manage going forward? And I think, to cut to the quick, the short answer, how we're going to manage going forward is like, it's not clear, because the demands being placed on the grid today are really unprecedented. Like, certainly, my entire career, like you can look at, the EIA data and look at, how electricity demand, virtually all economies, as they're starting out, electricity demand grows faster than GDP. And then it kind of tracks GDP for a number of years. And then eventually it grows slower. Like energy demand in total grows slower than GDP. So natural gas has been well below GDP. It might have been stagnant or even declining in aggregate terms, certainly for commercial and industrial. Commercial and residential. Electricity demand has been growing, but much more slowly than GDP. And I think the last decade until 2 years ago was basically flat. So this idea of like, electricity demand faster than GDP, nobody working today has ever experienced that. And then you compound it with, the way the utility works is the rates are based on the historical investment, right? So you have two things going on. One, there's been a tremendous escalation in the cost of the equipment. Gas turbines, we're talking about how expensive they are. And you're accelerating the pace at which you replace, the amount of new capital in the rate base. That ratio is increasing much faster than it ever has before, right? Ordinarily, it's like, you're replacing 5% a year. Well, now you're going to be replacing, 20% a year, or not replacing, but adding 20% a year. So your rate base, like the dollar value, is going to be rising much faster than inflation, irrespective of this rate of return issue. Now, the rate of return issue creates a perverse incentive for them to sort of put that on steroids, right?
Yeah.
So that's why you have these like massive rate increases. You see it in particular in California, but the rest of the country is starting to see this as well. And that's kind of just, that's just the inevitable. The rate of return has two benefits. One is just makes everything less expensive. So that ROE plus, because they gross it up for taxes. So if it's 10%, you're actually paying 14%. The customer's actually paying 14%.
Yeah.
Right. And it's not 14% of the bill. It's actually about 25% of the bill is this rate of return. Just their profit and the taxes on their profit is 25% of your bill. So, if you could cut that by 40%, which is about what their true cost of equity is, that's a material impact. That's about 10% of the bill right there, right? 25%, you take 40% of that, that's 10%, you're cutting off 10%. In addition, it removes the incentive for the utility, because now when they add rate base, it's just 1-for-1 in their market cap. So they're just on a treadmill at that point, right? It's like I can raise $1 billion from investors and it turns into $1 billion in my market cap. And they're kind of indifferent. They'll still invest, right? But it's not like it's not like it's on steroids. It's just like you're earning your cost of capital. Just like the bondholders, they invest and they just get their expected return. The other investors are investing and they just get their expected. They'll still invest, but they're not going to get these outrageous returns anymore.
We receive a lot of questions from business leaders around the world wanting to learn more about the energy transition, what is possible, and where to start. So to help you stay informed and up to date on best practices, opportunities, risks, and success stories, we created an industry newsfeed at VECKTA.com/news with all our podcasts, blogs, and newsletter. Check it out and connect with Dan, myself, and the VECKTA team to learn more. Cheers and have a good one.